Hello, I'm Mario Toneguzzi, managing editor of Canada's podcast, Taking Care of Business Today with Phil Soper, president and CEO of Royal LePage. Thanks for joining us today.
Pleasure.
All right, let's talk about the company's recent report, Q3 home price update and market forecast. So we're going to talk about a couple of different segments. Let's start about prices. What does the report tell us about what's happening with prices in Canada these days?
Well, they are going nowhere fast, either up or down. If you look at year over year prices, we're up less than 2%, almost flat at 1.6. And compared to last quarter, things slowed a little bit in the third quarter over the summer, and they're down 1%, 1.1%. So, normal in Canada is for home prices to appreciate between 5 and 6%. That's the long-term 50, 60-year average. So we're truly in a holding pattern here and have been for some months now.
Why is that?
The economy remains stable. Call it stable strong. Unemployment inched up a little bit, but just a little bit. We're still in better shape than we are over the long term. We've seen robust population growth, which puts upward demand on housing. Rental prices remain high, so it's not a particularly attractive option for those who are deciding between rent or buy. So home prices are stagnating. The reason they're not going up is because demand is much lower. We're sitting at about 2008 levels of transactions, the number of homes actually being bought and sold. And of course, the country's grown tremendously since 2008. So on a population adjusted basis, transaction count is low. So we've got low transaction count, but no one's willing to let their home go for what they perceive to be less than it's worth because they're working, they're making their mortgage payments, and there's no reason for them to do. So treading water would be the second and third quarter of this year. That would be the operative term, I guess.
So when you're looking at demand, what's impacting that these days? I know, affordability has always been an issue, in the last couple of years. And then, of course, the interest rates are up, but now we're starting to see interest rates go down. We're also seeing, I know RBC the other day put out their housing affordability report showing that affordability is improving, although slightly. Has that been the major reason for demand being kind of muted a bit?
Yeah, no, you raised some good points. And maybe I'd start with the RBC report. They're focused on absolute affordability, not affordability versus the trend over the last 20 years. The trend over the last 20 years is that home prices have been rising at a faster rate than wages and salaries. And for the past 2.5 years, that hasn't been the case. Home prices have been flat. In some regions, they even gave up a little bit, and wages and salaries continued to grow. And we've seen 3 consecutive cuts to the bank rate. So compared to where we were in recent memory, affordability has improved materially. So why have the buyers not shown up? I think 2 classes of buyers, which represent a significant portion of the typical transactions in Canada, are sitting on the sidelines and waiting. The first is the first-time home buyer. We've trained them to wait, and every 5 or 6 weeks they'll see a drop in the bank rate, and home prices aren't changing. And of course they are very mortgage focused because they're not bringing equity to the table like existing homeowners. So yeah, they're just waiting. And until home prices start to tick up, there's no penalty for them to wait. So that's group number one. Group number two, which is a very important part of our rental stock in the country, is the small business or the individual investor, the landlord, the small landlord, which make up the majority of the rental housing landlords in this country. Uh, the math hasn't worked in recent years. You know, some of them are willing to go negative on cash flow in the early stages of owning, say, a condominium, um, if the underlying asset's appreciating. So if the condominium's appreciating at 5 or 10%, and the rent they can get is X, and their mortgage payment is a little more than X, they're okay with it because the asset's appreciating in value, and they know rents will catch up as the mortgage payments come down. They'll pass, and they'll be cash positive. But with home prices stagnated, flat, the math doesn't make sense for them now. Although with each interest rate drop, more of them are getting back in the market. But overall, I'd say those two groups are missing, and that's really hurt demand.
Okay, let's talk about inventory now. I know that over the last year or so, we've talked a lot about a shortage of housing supply in the country. Where are we at with inventory right now in the country?
Interesting. You could really skew the truth here depending on which statistics you're using. So, so let me give you the sort of the whole story. Firstly, inventory is way up. If you look at RealLePage.ca, which is the busiest real estate company website in the country and has been for years, we saw in September the highest level of inventory of listings in company history. And RealLePage.ca got going in 1995, so that's a long time ago. The up 19% year over year. So what does that say? Well, it says existing homeowners are ready to trade up. They're ready to find more appropriate accommodation. They may have been in that home for 2 years, 5 years, whatever. They're ready to use the equity in their home to trade for another one. The cycle of the economy or the real estate economy isn't moving smoothly because those first time home buyers aren't buying the entry level homes.
Yeah.
So if you just listen to that, you say, my God, inventory's way up. The supply crisis has been solved, but that is not the case. Overall, the number of people in this country who are underhoused, who are looking for a place to rent or buy, versus the number of homes available is still way, way behind. And
Mm.
unfortunately, this period, this post-pandemic market downturn or correction, has taken politicians' eyes off the supply issue that we have, and it is a critical one. And as soon as the market does turn around, maybe with the next interest rate cut, maybe two more 25 basis point cuts, certainly by next spring, we're going to be talking about a lack of homes in this country again, and we'll have lost some ground, unfortunately, in terms of addressing the problem.
All right, last question for you. What can we
Sure.
expect? What can we expect into 2025?
Yeah. So if I look at where we think this year will end up versus 2023, so the year over year forecast, we've adjusted it slightly. We've adjusted our most expensive markets down. That would be Toronto and Vancouver because that's where we're seeing the biggest challenges in demand in the marketplace. So we're only looking at 3% year over year price appreciation in Vancouver, and Toronto has dropped down to 6%. However, if you look at our Quebec cities in particular and Calgary, you're seeing close to double digit increases, 8.5 in Montreal, 8% in Calgary. And the home prices are much different. Just over 500,000 in Montreal,
Yeah.
around two-thirds of a million in Calgary versus 1.2, 1.1 in Vancouver and Toronto. So yeah, year over year, we're looking at those kind of price increases. I think where we're on a quarter over quarter basis, those numbers will be smaller. And facing into 2025, we'll release our formal forecast in just a few weeks, and I'm sure we'll have a chance to talk again.
Mhm.
But I would expect something of a knee of a curve, a hockey stick in demand come the spring of 2025. We've got a huge amount of built up demand in the country, and there are two more Bank of Canada policy meeting, interest rate setting meetings in 2024 alone
Yeah.
before we get into next year's meetings. And I anticipate we'll see additional cuts to the bank rate at that time.
All right. Wonderful. Thanks, Phil, for joining us today.
My pleasure, as always.
That was Phil Soper, President and CEO of Royal LePage. I'm Mario Toneguzzi, Managing Editor of Canada's Podcast. Thanks for joining us today.